Hey, Robert.
Hey, you're on.
So last time we talked about FTX. I think there's more to say about FTX. A lot has been kind of disclosed over the last week. And of course, FTX filed for bankruptcy on Friday. Sam Beckman-Fried, SBF, is in the Bahamas under, I guess, supervision of the police. The police are watching him because there's flight risk. Everybody's now waiting to see, okay, how this kind of unravels in terms of all the information that'll come out in the months to come, probably in court, as bankruptcy courts figure this out, and as people sue each other over this, we'll discover more and more. But already we know quite a bit more than we did a week ago. So,
and none of it good.
Yeah. So what struck you in terms of what we've discovered about FTX that I don't know. I don't think anything really surprised me. I don't know about you. It kind of played out.
It surprised me.
It surprised you?
Yeah.
In what sense?
Well, I was hopefully optimistic that FTX was the kind of meltdown that we see in finance when people underestimate the devilish combination of leverage and illiquidity. So you can look back at long-term capital management, which was a massive hedge fund run by multiple Nobel Prize winners, the head of trading for Goldman, like the pedigree of pedigrees.
Yeah.
Extremely smart people, extremely experienced. And they, blew up the merger arb space along with some of the off-the-run treasury trades in 1998.
Yeah, and it all happened because of exactly this, right? Because they underestimated how illiquidity will strike. If certain things happen in the market, and maybe it's a 1 in 1,000, but when they happen, you both suddenly illiquid, and you've got a ton of leverage, and you just implode. There's just nothing left to do.
Yeah, it's super tempting when you're investing to go long things that are a little less liquid and short things that are more liquid so that you can capture the liquidity premium. It seems like super easy money, and the gaps are relatively small. The thing is, liquidity gaps are not fixed. And when things get bad, they get much worse. So you're losing money and you lose liquidity all at the same time. So that's the pernicious combination. And that's what I thought was happening at FTX, that it was dumb in the sense that we've seen this play out. It happens. It will always happen. If you're lucky, you make a lot of money beforehand, and it looked like maybe SBF had done that, and then you move on and wait for those circumstances to show up again, and then you see the same, except it's not that. This is not innocent mistakes. It's less innocent mistake, nefarious mistakes, and we see this too. It's just we call it fraud.
Yeah, and this is the kind of fraud that I think is typical in business. It's not the fraud where somebody sat down. I think, right, we'll find out, but I don't think it's the kind of fraud where somebody sat down like Bernie Madoff maybe and said, okay, how do I steal money from my customers and my best friends? This is the kind of fraud where I'll do this one little thing and I'll fix it later. It's not a big deal, right? So Alameda's a little short. Alameda's another entity owned by the same guy. They're a little short of cash right now and they need to cover something. I'll lend them some money off of the balance sheet. I know I'm not supposed to do this, but it's fine because we're going to make money in Alameda ultimately, and I'll pay it back. And you lend a little bit of money, but it turns the other way. They need more money, and you lend more, and at some point, it's irreversible. The same thing happened. A lot of the bankruptcies in the late 90s, early 2000s with this kind of thing. I don't want to report bad earnings because the stock price will come down. Next quarter will be much better. So I'll smooth them out next quarter. And that often happens, and I think it works for a while. Well, but if next quarter is worse.
Well, I think this is one of the few times where I think you're more generous. You're usually very, very skeptical and cynical. And we definitely seen this. I mean, I'm sure it goes back thousands of years, but you can take the savings and loan industry where you're insolvent, but nobody's calling you on it. So it's kind of heads, I'll win, tails, somebody else loses. And in the case of the SNLs, it was the Federal Deposit Insurance Fund more than depositors. But in the case of FTX, there is no such thing. So it's going to
So
be
the heads and tails here was with SNLs that they made very risky investments on things that either could make a lot of money, but much more likely would lose everything.
Arguably almost a sure thing,
Yeah.
given the
There's a lottery ticket, like a lottery ticket.
Yeah, and so even that is it's understandable. It's wrong. It's generally illegal. It's a bad way to run business, and I'm sure that it works out sometimes, and we never hear about it. In this particular case, it certainly fits that profile because you have Alameda Research, which is a crypto hedge fund. And early in the crypto days, there were massive inefficiencies in the crypto market. And so you could make money, and the trade that people talk about is you could buy Bitcoin in the US and sell it in Japan and pocket a huge spread.
Yep.
And everything is on the blockchain. So you're in theory doing this simultaneously. So it's like a perfect arbitrage. And maybe it is actually a perfect arbitrage. I don't know, but it's very enticing. So you start doing it more and you pull in capital and you lever up and you're making fantastic returns. But when markets are seamless, then inefficiencies tend to go away. So today you can't buy Bitcoin in the US and sell it in Japan at a 20% premium. So you have to start looking for things that are, okay, they're a little bit riskier, they're a little bit illiquid, and that's when you start to get in trouble. In particular, when you've had so much success early on, you're also a little bit overconfident. And you can definitely imagine, and this is pure speculation for us, we don't know anything here, but we do know what we do know what this is.
What we know, yeah, a little bit.
We know situations that have fully played out where we actually do know the facts.
Yeah.
And if this is similar, then it is something where there is a little bit of a shortfall, and it looks like a really good opportunity. And your incentives are not to come clean and take the hit. Your incentives are, well, we're all going to make money off of this.
Yep.
And if it works out, then you do. And when it doesn't, you end up in the news.
And I think you made the point last time that so much of crypto today is just crypto trading. There's no there again. There's just this coin versus that coin, and this coin's going up and that coin's going down. And if you can catch the one on the up and sell the one on down, and it looked like Alameda was doing that, plus doing venture capital. So a lot of the money, and talk about illiquidity, right? They were putting a lot of money, investor money into illiquid startups in this crypto space. And they were doing that while borrowing money. I don't know who was lending them the money. I don't think it was the banks.
Collateralized.
Yes,
by hypothetical crypto.
Well, and it was also collateralized, it turns out, by FTX, which was in a sense backing them up, and that's part of where the transfer happens, which empties out any kind of liquidity and any kind of ability to FTX to actually respond when they need liquidity, when they need money.
Yeah, the relationship is hypothetically, it's totally legitimate. If you are a crypto company, just like if you're an investment bank, you can lend money, you can do transactions. We talked last time about counterparty risk, and what we didn't know at the time was just how big a counterparty Alameda was for FTX.
Yeah,
and that looks bad. I mean, it's not by definition bad, but it looks bad because your incentives are not as aligned if you're transacting with third parties. So we generally prefer arm's length transactions. And in fact, in most regulated markets, they're either required to be arm's length or they're required to be immediately disclosed, both the size of the transactions, which makes for interesting reading sometimes. But in this case, we really didn't know a week ago how big it was. I assumed it wasn't that big, that FTX had a relationship, but there was a firewall. It turns out not at all.
Not at all.
But it gets even crazier because, I hate to say it, but last week I thought it was long-term capital management was the analogy, but this week I think it's Enron. Because you've got hidden losses, you've got affiliated entities, you've got transfers to cover up losses in one from the other that then blow up them both. And it's in the crypto space. So for people who don't know, Enron was a large company that got into electricity trading, energy trading generally, but they made a bunch of money trading power with the state of California because the state of California is crazy rules about power generation. And so Enron's energy trading department was making a lot of money. So that's basically Alameda Research. So, you've got a trading group that's making a lot of money. And then, of course, it grows, it levers. What could possibly go wrong? We're definitely, good at this. And then the circumstances that allowed for it to be so profitable go away. And in the case of Enron, they started losing money and they started hiding it. In the case of Alameda, I assume they started losing a lot of money. So how are you going to hide it? Well, since there's no accounting in crypto, it seems like it'd be super easy to hide it, but you need to have something. I mean, everyone has a balance sheet. So you have assets and you have liabilities, and the assets in crypto are crypto and the liabilities in crypto are usually crypto too. And it all looks very fuzzy and opaque, except the nice thing about crypto, the amazing thing, I retract the word nice. Just wow, it's really hard to even wrap my brain around it, because what Alameda and FTX did is they created additional cryptocurrencies.
Yep.
So we all heard about FTT last week. It's very common for a platform to have a current cryptocurrency attached to it. It's not great to have that be a big part of your capital. If that's your main asset on your balance sheet, you got to wonder. But it's just pretty normal. But Alameda and FTX created additional cryptocurrencies. So it's as if you were Enron and you've blown a hole in your balance sheet because your energy trading went from very profitable to huge losses. If you could issue the Enron coin, and so everybody thinks your energy trading
Create an asset out of thin air.
Create an asset out of here, but you link it to something. There's something there. There's some blockchain there. There's some protocol there. In this case, you might say, okay, we're creating a tracking stock, call it Enron coin, and it's going to get 10% of the profits out of the energy trading business. And everyone knows Enron has made all this money in energy trading. So you create out of thin air 10 billion Enron coins, and you sell 100 million. And because people are excited to get some of the profits, they're willing to pay $1 per coin, even though it's highly speculative. And so you bring in $100 million. So now you have $100 million. That's great. So you're better off because you have $100 million. You do have this liability, but it's a perpetual coin. It's not really a problem. It's like having preferred stock or tracking stock or something. Then you've got additional money. So you've potentially plugged the hole. And you could have issued Enron stock to do this. Like, this is a legitimate way to raise money. But no, what you do is you take the fact that those coins each sold for $1 and you say, look, we have 9,900,000,000 of these coins, and they're worth $10 billion.
Yeah. And
suddenly your balance sheet is fortress because you have a $10 billion asset that you created out of thin air.
Yep.
You're collecting part of the profits from the energy trading business, which aren't any, but you're collecting it from yourself. And you're collecting it from yourself. It really is created out of thin air. And if you tried to sell the other 9.9 billion Enron coins, the price would go down a lot. And so it really is creating an asset out of thin air. And that's what Alameda Research and FTX did. And it can't possibly, if you carry that at 100 million, the cash you got, totally legitimate. If you carry it at 10 billion, it's fraud.
Nuts. Yep. And once that was disclosed in an article, people started selling. And then once people started selling, Binance, who owned a big chunk of FTT, said it was going to sell, which meant everybody else started selling. And then suddenly you discovered that these coins they had were worthless, or worth a lot less than what they were carrying at.
And that was predictable, but it was particularly predictable when you're also disclosing that the energy business is actually losing money.
Yep.
So once you get in trouble, all of these affiliated entities go down because you created them in an interlinked fashion. There's no reason that Alameda Research had to take FTX down or vice versa. But when you structure it the way it turns out that they did, it's inevitable. So large losses in Alameda, you cover them because you're entangled anyway. They don't make the money back. I don't know what happened to the money. It's an interesting question, because when you're Enron, you create $10 billion asset out of thin air, hypothetically, they created it in accounting fiction. Then you now can answer, and then you're discovered, you can answer the question, where did all that money go? Because, okay, they lost it trading electricity futures. I have no idea where all that money went.
Well, some of it was lost by Alameda, some of it was invested in crypto startups, and some of it was donated by SBF to the Democratic Party. He's the second largest donor to the Democratic Party after George Soros. I think he gave well over $100 million.
Yeah, but I'm sure the Democratic Party will give the money back to make the customers whole.
Oh, of course. Yeah. No question about that.
I hear you, and I'm sure all of those and probably 5 other things that we haven't thought about. It's the same question we had after Terra Luna. After Terra Luna, where did the money go? Money came in. Now, I think that in the case of Terra Luna, they had been buying. No, I don't think they had been buying a bunch of more robust crypto, basically Ethereum and Bitcoin, to create some actual explicit backing.
But it was just a fraction of the loss.
It was just a fraction, and it took a day or two to burn through that once the run started. I'm sure FTX did the same thing, because right now, from what I can tell on their balance sheet, they have no Bitcoin or Ethereum or dollar.
So they sold it all.
They tried to, if they could just, if you remember the classic "It's a Wonderful Life." And they're about to go on their honeymoon, and they've got the money, and then they have the run on the Bailey Savings Building loan, and they're giving it out, as they get closer and closer to closing, and they end up with $2 left, and it saves the day. Well, that's always how it goes. Is if you have a big hole in your balance sheet, but you have some liquid assets, when the run starts, you there's nothing to do except hope that we can convince the run that it's unnecessary, and they turn away before we run out of money.
Well, and it turns out SBF was lying the entire time. I mean, that was interesting. And he was trying to raise money from Silicon Valley. It went to $6 billion. I guess it changed during one day. It started at 1 billion and landed up at 6. Good for Silicon Valley for not giving him anything this time. But it is pretty amazing how some very, very well-known venture capital funds got burnt on all of this. And I think Sequoia sent out a letter to investors last week, basically that they're writing their investment down to zero. Inevitable, that's what it's worth. But we've seen Sequoia lose a lot of money very quickly before. So their business model allows for it.
It's part of the program. But I think that what this really drills home is that crypto is different than the traditional Silicon Valley startup ecosystem. And what works in that ecosystem doesn't necessarily work in crypto. And unfortunately, what I think has worked for investors in crypto so far has been pump and dump. There are people who made a lot of money off of Terra Luna. And this is not the direction that you want your new financial system to be evolving in. Venture capital is ideal in a sense for funding innovation, because it's extremely long-term, it's extremely patient, extremely willing to take risks. And everyone in the ecosystem understands that zeros are going to happen, and even they may even look bad like this, but that overall the picture works. Crypto, there's no evidence of that yet. And it's really, that's the biggest takeaway from the last week, is it's really depressing that we have such blatant evidence that that crypto is a zero-sum game. And Silicon Valley is used to losing lots of money and having having a value created but not captured, and then eventually it's captured. But I think that there's a gap that, and we've seen it. We saw it with our classic web van, but
Yep.
pets.com, a bunch of internet companies where there was no value being created, even though it appeared there were, because they were growing customers very quickly. The metric for value creation is usually customer acquisition, because if you're
Yep.
giving your customers something great, then they come. So, you see with Google and Facebook and Apple, you just see massive customer growth.
And ultimately that will translate into profits.
And then you can capture some of that.
Yes.
But in the case of a pets.com or a web van where you're selling at a loss and have no real path to having
Yep.
that be at a gain, then you're not creating value. You are getting customers because you're transferring money from the company to the customers.
Mhm.
And maybe eventually you turn that around, like Uber and DoorDash, they arguably did this, and there are massive network effects. You can even justify it in advance and say, okay, we're going to lose money for a long time, and then we're just going to make a ton of money because we'll have this massive platform that's extremely valuable. Crypto has no evidence of a massive platform being extremely valuable. It all seems to be zero sum. Unfortunately, I mean, okay, it's a value judgment, but unfortunately,
Yeah.
it seems like in crypto, it's not transferring from the company or the entity or the effort to the customers, but rather from the customers to the entity. So it's zero sum, except like gambling, the house takes a chunk of it. And that's, I mean, we said it last week, we have nothing against gambling, but it's not something that gets us excited about it.
Not a productive endeavor at the end of the day.
No, it's all
So,
entertainment.
so any thoughts on Bitcoin and Ethereum, which they're down a lot for the year, but they're not approaching zero. They seem to keep getting levels and holding out, and it's not a panic. While it might be a panic for a few hours, but it doesn't seem like it's a panic that's sustainable. Any thoughts on where that goes, or is there an out here? Is there a viable business ultimately here?
I don't know.
Yeah,
I
we'll
mean,
see.
I was a lot more optimistic a week ago and a month ago.
Yeah.
But if you think about Bitcoin and Ethereum, just for example, they're going to benefit. And we've seen this. There's a flight to safety.
Yep.
In these markets. Now, it could be that everyone just says, I'm selling all my crypto and I'm out. And some people are doing that.
I'm sure they are.
But if you're not doing that, I'm going to sell my altcoins and go into Bitcoin and Ethereum. And Bitcoin has its own set of issues because it's a transactional product. It's not built to create value outside of people transacting, which creates an enormous amount of value. It's just something it's a problem that's already been solved. Versus Ethereum, which potentially is a lot more interesting, particularly with the move. And I'm not an expert on it, but proof of stake is really exciting because when you have this massive, costly security going on in the background, like with Bitcoin, they talk about Bitcoin uses the equivalent of a small nation in terms of electricity. It's really hard to create value because you've got this big drain. Now, that doesn't mean you can't. I mean, aluminum smelters create value because they take rocks and make aluminum with massive amounts of electricity, but there's this transition and Bitcoin doesn't have that. But with Ethereum, there's the potential for the kind of ecosystem that could be really exciting with very, very low costs, very, very low frictions that gives crypto an opportunity to evolve into something real, into something where there's value being created.
And Ethereum's, Bitcoin is clearly focused on becoming becoming money, being used as a medium of exchange. Ethereum seems to have a much broader mandate in terms of smart contracts, in terms of actually creating networks that will actually produce some value. We still don't know what that value is going to be exactly, but some value. There's a vision around getting rid of middlemen. There's a vision around making things run more efficiently, which is enormously valuable if you can pull it off. Most of these coins seem to be self-referential. You've got a coin for the sake of trading a coin. So whereas Ethereum seems to have some vision around it. We will see.
And that's what's encouraging, that they're holding up. Bitcoin could solve this problem. They could create another layer where that's possible. It could move from proof of work. It kind of have to eventually, because unless you have massive fees being generated on the network, I don't know how you compensate miners. I mean, miners are already going out of business when Bitcoin goes under 20,000. If it goes under 16,000, if you don't, so we'll see. But I wouldn't give up on crypto. It's just really discouraging that one of what was viewed as the leading firms in the sector turns out to be all smoke and mirrors.
Yeah, I mean, on the more pessimistic side, Dogecoin, which was a coin that was created as a hoax, as fun, and then sped up. It's holding up pretty well too. So
well,
go figure.
That barbell doesn't surprise me at all, because you have what's real, and FTX was supposed to be real, and then when it's not real, nobody thinks Dogecoin is real. It is pure entertainment, and it may have some transactional uses, but meme coins are they're very clean. If you think about,
because emptiness is cleanliness. Yes.
Emptiness is cleanliness, but it doesn't pretend to be anything. There's no pretense.
That's true. Dogecoin is honest about it. That's their virtue to these meme coins, and that they're honest about it.
There is nothing there.
This is pet rocks.
Nope, this is it. It's pet rocks.
It's pet rocks. Okay. Yes.
On the blockchain, and there's something elegant about that, and it's convinced me, that and GameStop and all that nonsense, that there is an element of Dogecoin in every financial security that has any sexiness to it. We always wonder how much a Tesla stock price is because Elon Musk is so popular, or because people love Teslas, and how much of it is real business model. And to some extent, that to a much lesser extent, I think it applies to Apple, and then to other cases like GameStop, it applies much more. But I've definitely come around to the idea that humanity infiltrates every price, even ones that seemingly should be completely rational.
All right, I'm sure you will discussing crypto more in the months to come.
So what do you think we're going to find out in the next week?
I don't know. I mean, I don't know that we'll find out much. I think now it goes to courts. It goes to the, it's a long, kind of messy process of unwinding this. It'll be interesting to see if he's arrested, if SBF is arrested. It'll be interesting to see what happens to companies like Binance and the others who are claiming. So the big rush right now, which is interesting, the big rush right now is to do this verification of your collateral, and there's a big debate going on within the crypto community about. So there's automated verification, but of course, automated verification is just snapshots, and it's not as accurate. You could have human verification. You could go in and look at account by account and check it. But that's kind of anti-crypto. That's kind of the opposite of what you want if you're in the blockchain.
The accountants take over.
Yes. So there's a huge, I think, philosophical, if you will, battle within the crypto community right now about what kind of verification they're going to allow. And different companies will come up with different models, and they'll compete. And then, of course, if that's done properly, then my guess is we'll discover a few other FTXs out there. We'll discover a few other empty shells. So there'll be more of this, and then we'll see who remains standing. And then, of course, the question always is, what are the exchange good for, right? These exchanges are good for trading in coins. But if a lot of these coins are going bankrupt, if a lot of coins are going to disappear, if they lose their value, are the exchanges just going to be exchanging Bitcoin for dollars? Is there money to be made in doing that? How much can they increase their fees by to do it? We have one that's publicly traded, right? I mean, it's Coinbase. So I haven't looked at the stock price. That I should look at the stock price. Yeah, I'm sure, but you wonder what's the business model. Once you take if everybody sees it as gambling and decides, maybe gambling's not what I want to be doing. What happens to Coinbase? What happens to Binance? What happens to the other exchanges? So I don't think it'll happen in a week, but I think over the next months, this is a story that's not going away. There's still, I can't remember how many hundreds of millions or trillions of dollars still in crypto. So this is still a massive piece of the market. It hasn't all gone away.
Yeah. I mean, if you strip out Well, let's really, there are two things. One is, I guess there's three things. One, I agree with you
Yeah.
on all of that. I do think that we should pay particular attention to the idea of counterparty risk, because that's probably what killed Alameda, is that they lost a bunch of money when crypto melted down, not necessarily because they had bad trades, but because they had bad trades with bad counterparties. So the trade ostensibly made them money, but they ended up losing a bunch of money because the other side couldn't perform, or actually,
It was something to do with Three Arrows, the venture capital fund that went under.
It's very possible.
Alameda had some kind of relationship there. So,
and we're going to see more of that. But then there's the other side, is who is Alameda and FTX going to take down? Because there's so many firms that had relationships with FTX, because it was the institutionalizing, they were going to institutionalize trading for crypto. So that's going to be really interesting. And they both had massive balance sheets, much bigger than.
And since we do banking, I'm curious if there are any banks that Silvergate was very quick to come out and say, we have no exposure, or no loans or debt or anything like that. We'll see if it lands up being true. But then who else? Somebody was lending the money. Is it private equity? Are there private equity funds out there that were dabbling in this? There's a lot of private lending funds that, as the economy has slowed, maybe have dried up, but crypto is exciting. It always goes up. Yes, I think that's going to be interesting.
I don't think the banks are going to hit, although there's always side ways that you can do it. Okay, like Silvergate lends against Bitcoin, and they, I think, take a 50% margin. So, they could lose money, but it's not likely to be a lot if they call margin quickly. And that's always the thing but you have other banks that have lost money because they were lending to Bitcoin miners. And so they end up with, a bunch of crypto computers.
Collateral that's not worth much.
Yeah, that depreciates at 8% a quarter anyway, much less the fact that nobody's getting into that business right now. So that's a good way to lose money. But if we go to, the question of what is crypto good for, it comes back to that, the stock market is extremely liquid, but it's not valuable just solely because it provides liquidity. Like that's not the end all. It's what does that liquidity enable? And it enables companies to raise money all the way back to the seed venture capital, because there is a end game. So the stock market provides an end game where you'll be valued at something that's reasonably related to the success of your business. And that brings entrepreneurs into Silicon Valley. It brings investors into Silicon Valley. It is the vacuum that pulls everything through that funding innovation and creating value shoot. And that's where crypto is missing. That's the underlying value creation. But if you get really interesting projects that are creating a lot of value happening on Ethereum, we've talked about if you have project-specific coins that are being used to help finance new enterprises or new efforts, and then these coins they need to be liquid, so they're trading in sort of a cloud, and some of them they liquidate, they disappear over time. All of that could make these exchanges super interesting, but they have to do more than just ride crypto as it goes up, ride the enthusiasm as people trade like crazy. There has to be something that's always there that doesn't depend on the excitement.
And that's, I'm still hopeful for the technology, in a sense that hopeful without, because, I can see some potential in the Ethereum kind of model, and maybe even Bitcoin, given that they've evolved quite a bit and Bitcoin keeps evolving. But it needs to be cleaned out. So you need to get rid of the gambling. You need to get rid of the gamblers, and you need to get back.
Keep it over in the meme section.
And you need to get back to what is the business model? What are you trying to create? What is the value added? And get rid of ultimately, I think Bitcoin will have to get rid of the utopians who think that they're going to replace the dollar in 5 years, 10 years or whatever. And get rid of central banks. I mean, I wish they were right. I'm sympathetic completely philosophically, as you know, But I just don't think it's there. There's no, it's completely unrealistic and detached from
And
reality.
I promise if it started happening, the Marines would show up.
Exactly. That's always been my point, is nobody's going to allow it to happen. But they need to figure out, okay, if it doesn't happen, given that it's probably not going to happen, what's the proposition? What is the value creation model here without it? And so that's maturity. That's when I think they get to maturity. And we'll see if this wakes people up, and if this in a sense forces them to be mature.
It would be exciting if the end result of this was a significant shift in the focus of crypto to making things really work, and not just making, I don't want to say just making money, not pump and dump. And the whole system has to be rejiggered, because it's grown up on pump and dump. And it's not surprising. Most markets do start out in pump and dump, but when they really start adding value is where they evolve into something more.
So I'm looking forward to the day of doing these riffs on something really exciting coming out of crypto that's actually impacting the world for the positive, and changing the world, the way we think about something, or the way values something important is created, or increased efficiency somewhere in a dramatic fashion. Still hasn't happened, but I'm not completely giving up on it.
Don't give up.
Yeah. All right.
Thanks, Yaron.
This was fun. Thanks, Robert.
Talk soon.
Yep.